Hello everyone, I am Pratap here. We are at part 2 of lesson 19. In this lesson, we will discuss about position size and risk management roles. And this is a very important concept. And this concept is not having any dependency on the earlier lessons. Anybody can attend. But I can say this is the topmost important concept in our entire course. The reason is position size concept is going to help you how to save your capital. So that always you will be in trade. Even if you get several losses, still you will be in the race. That's why it is such an important concept. In case if this is your first visit to our channel and if you want to learn the earlier lessons, all the earlier lessons I kept in a playlist, Supply Demand Zone Price Action course at our NeoStock YouTube channel. Even I have provided the link to that particular playlist in this YouTube video description. So from the video description, click the link. You will be able to access all the earlier lessons. Now let's get into this position size discussion. Previous video we have discussed about sets. The second S in sets is nothing but size. And this is also called as a position size. The short name for position size is size. And it is also called as position sizing. Both are same. Whether you say position size or position sizing or simply size, all are same. And the next point is very important point. The maximum acceptable risk should not be more than 2% on your trade capital, single trade capital. Single trade capital means whichever the stock currently you are trading. For that particular stock, how much money you are investing. That is called as single trade capital. That means specific to the stock you are trading. So what is the capital? So in that capital, you should not risk more than 2%. It is a thumb rule. We all must follow this rule. You may ask a question, can we have less than 2%? Yes, it is allowed. The maximum acceptable risk can be less than 2%, but it should not be more than 2%. 2% is the upper threshold value. You can keep only 1% or you can keep only 0.5% as our maximum acceptable risk. But up to 2% is allowed. That is what you should understand. Okay, how this particular point is going to help our capital. Even if you get losses, still this particular rule is going to save your capital. How it is going to save your capital, I will explain with a simple calculator example. Through calculator, I will explain. Let us assume you have a capital for single trade capital, 1 lakh rupees, and you want to invest this money and you want to buy a stock. So obviously you will be adding this 1 lakh to your broker's account, stock broker's account. Exactly the same way I am adding this 1 lakh to calculator. In calculator there is a M plus, memory add. I am adding into the memory. Now 1 lakh is saved inside this calculator. Let me cancel. Now click on this memory recall. See, now it is displaying 1 lakh. The value is saved inside. Okay, now using this 1 lakh, I have brought shares in a particular stock. Whatever the number of shares I get for this worth, 1 lakh worth, I bought those many shares. But here what is the rule? My maximum acceptable risk is 2%. So that is the way I have designed. Let us assume my risk is within that 2% level or exactly at 2% level for easy calculation. Let us understand that. So exactly 2% is my risk within my zone. And my maximum acceptable risk is also 2%. Both are exactly matched. So I accepted the trade. But what happened? the trade went against my analysis and it is stopped out. Because my maximum acceptable risk is 2%, so 1 lakh into 2%, so 2000 rupees. So into 2 divided by 100. So 2000 rupees loss I got. Okay, from where I have to deduct this money? From my capital. Already in this calculator, I have 1 lakh rupee capital. From that capital, deducting 2000 rupees. In calculator, there is an option called memory subtract, M minus. Let me click on this. Now from 1 lakh, this 2000 rupees is deducted. Now what is the balance? 98,000. Now in the calculator, you recall the memory? See, you got 98,000 capital. That means next time when I want to purchase any stock or when I want to invest this money in any another stock, because I got losses, so definitely I need to get back the money. So what I am doing, again I am purchasing. And one more important point I forgot to tell you. In all these trades, I am going to take with their RR, risk reward, 1:5. I'm supposed to tell this point before. But anyway, 1:5 RR only I am taking. That means if I get loss, I will be getting 2% loss. If I get a profit, I will be getting 5 times more than the 2%. That is 10% profit I will be getting. So this is the way I designed my trades. That means I am selecting my trades. Okay, anyway, I got the loss. My amount is reduced to 98,000. Now I am taking my second trade. Second trade also my maximum acceptable loss is 2%. And if it is successful, I will be getting 5 times reward I will be getting. This is the point you should remember. Okay. Now what is the risk? So into 2 divided by 100. So now I will be getting 1,960. I will be getting 1,960 rupees. Loss I will get if the trade goes against to me. If the trade is in our favor, what will happen? Into 5 times. 5 times 1,960 rupees I will be getting profit. Because all my trades are 1:5 risk reward trades. But unfortunately, my second trade is also stopped out. That means I got a loss. Now second trade I got 1,960 rupees loss I got. So what we have to do? We need to deduct this money from our capital. Currently our capital is 98,000 rupees. From there you need to deduct. So in calculator we have an option M minus, memory subtract. Let me click on this. So inside the memory the value is adjusted. So what is the capital I am having now? 96,040 rupees capital I am having. Now with this capital, now I have to take my third trade. So what is my risk? Maximum acceptable risk is 2%. Because I am always ready to accept a maximum 2% risk. At the same time, always I look for 1:5 trades. So my third trade is also, I have 1:5 trade. But risk is 2% maximum risk. So 96,040 rupees into 2 divided by 100. That is 2%. So 1,920 rupees 80 paisa. If analysis goes wrong, this is the loss I am going to get. Suppose if my analysis is good, what happens? Into 5 times profit I will be getting. But unfortunately, my third stock also stopped out. It went against my analysis. So what I have to do? The third time also you need to deduct this loss from your capital. So again I am clicking this M minus, memory subtract. Let me cancel. Let me recall the memory. So how much money is there in my account now? 94,000 119 rupees 20 paisa. Okay, now with this capital, I am planning my fourth trade. What is the risk I am going to bear? 2% risk on this capital. So 2% risk, how much? So into 2 divided by 100. So I will be, in case if my analysis goes wrong, I will be getting 1,882 rupees 38 paisa. Maybe something we can round to 40, something like that. Anyway, for time being, let us don't bother about these fractional values. So this is the loss I am going to get. If I get the profit into 5 times, because always I am looking for 1:5 trades. 1:5 RR, risk reward trades. Now unfortunately, my fourth trade is also failed. Now again I got another 1,882 rupees loss. So let me deduct this value from my capital. So by clicking M minus, so value is deducted. Now let me recall the memory. So at present I have 92,236 rupees in my account. Now I am planning to take my fifth trade. Fifth trade also the same. My maximum risk is 2% and the reward is 5 times to my risk. So what is the loss I am going to get in case if my analysis goes wrong? So into 2 divided by 100, that is 2%. So I am going to get 1,844 rupees loss if my analysis goes wrong. If my analysis is right, 5 times reward I will be getting. Now I am planning my fifth trade. Now my fifth trade is a successful trade. Because it is successful, for this risk 5 times reward I will get. So that means 1,844.73 into 5. 5 times reward. So let me multiply with 5. So how much profit I got? 9,223 rupees profit I got. And profit will be added to my capital. So for that I have to use a memory add, M plus, I am clicking. Each time when we got loss, we clicked on the button M minus. Now I am clicking on M plus, memory add. So let me click. So okay, I added. Let me cancel. Let me recall the memory. How much profit we got? After adding this, I got 1,01,460 rupees profit I got. Even after getting the losses. If you compare with my initial capital, what is my initial capital? 1 lakh rupees. So let me deduct 1 lakh. Still I got 1,460 rupees profit. A profit is a profit, whether it is small or big. When I got this profit, even after getting 4 losses, continuous losses, that means based on this strategy, 2% maximum risk, all our trades should not be less than 1:5 RR. If that is the case, for out of every 10 trades, even if you get 2 successful trades and 8 failed trades, still you will be in profit. Maybe a small profit, but still you will be in profit. But do we get 8 losses and only 2 profits? If you are using supply demand zone price action, definitely not. Definitely we have at least some 4 or 5 or 6 successful trades will be there. At least a minimum 4 or maximum 6 out of 10. That way we can plan. We have a concept, high liquidity zones concept. special zones identified with the help of our NeoStock software. They have even 80% success rate. For the last 5 months, the success rate is 88%. My objective is to reach 80%, but for the last, based on 5 months data, we got 88% success rate. Over 200 stocks executed so far, those high liquidity zones. Then imagine how much money they would have given to us. Even after getting continuously 4 losses and only 1 success, still you are in profit. Then imagine if more number of trades got success, you would have got even more profit. This is the worst case scenario. Worst case scenario also, out of 5 trades, 4 are failed, only 1 is successful. Even in that one worst case scenario, still you are into the profit. How you are able to get this profit? Based on the risk management rules. So that is the reason why this rule is very, very important. The maximum acceptable risk should not be more than 2% on a single trade capital, on any single trade capital. Maybe I would have written on any single trade capital. Never. It can be less than 2%. Some people can't bear 2% risk. They don't, for their 1 lakh rupees capital, they are not in a position to handle 2000 rupees loss for every trade. Maybe they can handle only 1%. They can keep their maximum acceptable risk as only 1%. Anything below 2% is okay, but you should not go beyond 2%. Either 2% or below 2%, you can set the value as your maximum acceptable loss. But not beyond 2%. 2.5%, 3%, 4%, you should not accept that loss. So this is a thumb rule you all should always remember. This is the only you will be survived in this market. Many people, they are not aware of this concept. Without this proper risk management, they will take a trade, they invest 1 lakh. In the first trade, they get losses, they keep on waiting. By the time 30% money, they will be losing. That means from 1 lakh, it come down to 70,000. Next trade, again they take. Again same thing will happen. Again they are watching. Another 20,000 rupees loss they get. Then they will exit. That means 50% capital they already lost. And if you want to recover 50,000 rupees back, do you know how much time you need to wait? It's not easy, right? So that is the reason why risk management is very, very important. This is one of the reasons why I introduced risk management early in our lesson 5 itself as part of our course. Because I know how important it is. At least you people will realize a little early. Many people talk about risk management at later stages. But I have introduced and I still continuing some points based on the topic wise. Now ultimately this is the whatever we are discussing, this is the final topic related to our risk management. So I want all you people to realize how important it is and how it is going to save your capital. This is what I meant by save. It saves our capital, this concept. Even after losing continuously 4 trades, still 5th one saved your capital. You may ask a question, even 5th one is also stopped out, 6th one is also stopped out, everything is stopped out. If you say like that, we cannot provide any answers to that. But it won't happen. We have seen supply demand zone is a very powerful concept. It is having more than 50% success rate. Even the normal zones. If you follow the trend, if you plan your trades according to the trend, more than 50% success rate you have. What I am trying to say, even 20% success rate will help you to save your capital. That is the worst case scenario I am telling. That is what I shown you in that example. Calculate through calculator whatever I calculated. Okay, so always remember the maximum acceptable risk should not be more than 2%. Either 2% or less than 2% can be acceptable. So it is up to you how much risk you are going to accept. Within 2% level you have to decide. Whether is it 2% or is it 1.5% or is it 1.2% or is it only 1% or is it only 0.08%, that you have to decide. That is your rule. But your rule should not be more than 2%. This point I am making very clear to you guys. Okay. So risk per share. How do we calculate this? We already discussed in our lesson 5. Risk per share, always you calculate entry minus stop loss, and that should be an absolute value. Absolute means positive value. Because the demand zone, it will give positive value, entry minus stop loss. Supply zone, it will give negative value. That's why absolute always converts the negative values to positive values. So that is the risk per share. You have already learned this point. Because you learned, you might forget. That's why I am trying to explain once again. This is risk per share. Always remember. Let us assume, let me give you an example. You want to take a trade in a particular stock. And entry price is 200 rupees. Entry price. And the stop loss is 196 rupees. So what is the risk per share? 200 minus 196, that is 4 rupees. See here, 200 minus 196, that is 4 rupees is the risk. Here 200 is your entry and 196 is your stop loss. That means this is your proximal line and this is your distal line. Time being, let us don't discuss about stop buffers for simplifying our discussion. Or you can say we included everything as part of this. But this is your entry, this is your stop loss. So that means 4 rupees is going to be the loss for each share you are buying. In case if the analysis goes against you. That is what I meant by risk per share in this example. Then how do we calculate the zone risk percent? 4 rupees is the risk. In percentage, how do you convert? Because for 200 rupees, you got 4 rupees loss. 100 rupees, how much you will get? That means 100 into 4 divided by 200. That is what I mentioned in this formula. 100 into 4. What is 4? Risk per share. Divided by 200. What is 200? Entry. See, it's in our childhood days, we already learned in simple maths. For 200 rupees, 4 rupees is the value. 100 rupees, how much? So 100 into 4 divided by 200. That is what in the formula we specified. See here, 100 into 4 divided by 200. So finally, how much value we got? 2. That means the risk of the zone is 2. Why we calculated the risk of the zone? Because we want to compare the risk of the zone and our maximum acceptable risk. Suppose my maximum acceptable risk is 2%, then is the risk of the zone, that means zone risk, is within my acceptable level or not, I need to observe. Because I am accepting up to 2%, the zone risk is within my acceptable level. Exactly 2 and 2 are matched. So that means whatever the value, the zone risk you are deriving, either that should be equal to your maximum acceptable risk, or it should be less than the maximum acceptable risk. If it is more than your maximum acceptable risk, it is a problem to you. If you take a trade, if the trade goes against you, you will get loss more than what you are accepting the risk. Let us assume my maximum acceptable risk is only 1%. Say for example. But what is the zone risk? 2%. If you take a trade, how much loss you will get? Maybe 2000 rupees loss you will get. But what is that I am accepting? Only 1000 only. I am affordable only accepting 1000 rupees loss. But if I take a trade, I will be getting 2000 rupees loss if my analysis goes wrong. Why? What is the reason? The reason is you kept a rule. What is the rule? Your maximum acceptable risk should not be more than 1%. Because we are accepting the maximum acceptable risk can be less than 2%. It is you have to define how much value you want to set. But whatever the value is set, that should not be more than 2%. That is the ground rule. That is the thumb rule. So if your maximum acceptable risk is within 2%, you can accept this zone. That means zone risk you can accept. If your maximum acceptable risk is 1%, you cannot accept this zone because zone is providing you more risk. Okay, let me show you one example. The zone risk is 2%. See the condition here. If the zone risk is within the maximum acceptable risk level. What is the zone risk? 2%. What is your maximum acceptable risk? It is up to you. Say for me, I want to accept up to 2%. That means my zone risk and my maximum acceptable risk, both are within acceptable levels? Yes. Zone risk is 2%, is within my maximum acceptable risk 2%. So both are within the acceptable level. If that is the case, then you have a position size formula. When you have to apply this formula, if the zone risk is within the maximum acceptable risk level, then only whatever the formula I am going to show you, you have to apply the formula. What this formula is going to tell you? How many shares you have to buy, it is going to tell. It is a very simple formula. And this formula tells your capital divided by your entry price. Position size equals to your capital, single trade capital, trade capital. That means whatever the money you are investing to buy on that particular stock, that money, that is single trade capital, divided by at what price you want to buy, that is your entry price. Whatever the number of stocks you will get, whatever the value you get, those many stocks you can buy. Why? Because your zone risk is within the maximum acceptable risk. That is the condition you have to remember. You may ask a question, if it is not within the acceptable, that we will discuss later. Let us don't mix multiple concepts. First focus only on this concept. If the zone risk is within your maximum acceptable risk, the zone risk can be 2% or it can be 1.5% or it can be maybe 1% or less than 1%. But your maximum acceptable is up to 2%. Up to 2%. So any of these zone risk you can apply this formula. If zone risk is more than 2%, then a problem will come. You can't use this formula. Okay, hope you got the clarity. Now in this example, our zone risk is within the maximum acceptable risk. Now let me, in our previous examples, we already discussed our capital is 1 lakh. Let us assume our investment capital is 1 lakh. If it is 1 lakh, how do you identify how many shares you have to buy? 1 lakh divided by entry price. What is our entry price? 200 rupees. In the previous example, 200 is our entry price, 196 is our stop loss. And 4 rupees is the risk per share. That is 200 minus 196. That is what we have seen in the previous slides. So that's why in the example 1 lakh divided by 200, finally it is given a number 500. So what this formula is telling, you can buy 500 stocks for this particular stock for your capital 1 lakh. See here you got exactly 500. Sometimes you know what happens, you may get fraction value. Let us assume the value, not in this, maybe slightly difference is there. If these values may be 199.99 something like this. Let us assume the value you are getting 499.70. Let us assume it has given a fraction. Now how many shares I have to buy? You have to remove the fraction value. If you remove the fraction, what is the remaining value? 499. So you have to buy only 499 shares. If a fraction is there, remove the fraction and then whatever the remaining value, buy those many. If the value is 499.70, you have to buy only 499 stocks because you can't buy 0.7 stock, right? Okay, but in this example, exactly we got the number, round value we got. Because some people will get these kind of doubts. Because I got a value 499.59, how can I buy 0.9 stock or how can I buy 0.7 stock? So I want to stop asking such kind of silly doubts. So that's why I am telling you, you should not use the fractional value. I made it clear. Okay, now previous slide. Once we get into the previous slide. Previous slide, look into this, highlighted with red color. The maximum acceptable risk can be less than 2% also. You can choose. If you feel that 2% is very high for you. Say let us assume I can't accept, for my 1 lakh rupee capital, I can't accept a loss 2000 if my analysis goes wrong. I can't accept. The 2000 rupees is very valuable for me. Maybe I can accept up to 1000 rupees loss. Not more than 1000 rupees. That means my maximum acceptable risk is only 1%. Is this point clear to everyone? Even though this concept tells you can take up to 2%, but I am not taking up to 2% because I don't want to lose 2000 rupees. It is okay if I lose 1000 rupees if my analysis goes wrong. But I cannot bear the loss beyond that. But what is the zone risk? Zone risk is 2%. What is my acceptable risk? 1%. So it is not meeting my risk requirement. Because if I take a trade in this zone, I will be getting 2000 rupees loss. But I cannot afford more than 1000 rupees. Now can I take a trade in this zone? Because zone risk is 2%. Okay, we may say we cannot take a trade. Because if we take a trade, if our analysis goes wrong, we are getting 2000 loss. But we can accept only 1000 loss. So it's not meeting our requirement. Maybe we can look into some other stock. That way, some people can give suggestions. Right? But here, for me, this stock is looking very attractive. Because the stock is completely, all the conditions are in our favor. Trend is in our favor. Odd enhancer score is excellent. Location is perfect. Price direction is good. Even EMA confidence is also there. I got the maximum odd enhancer score. Even after fine-tuning the zone, I have identified lower time frame fine-tuned zones. That means institutional real order flows. So in my analysis, the stock is looking amazing. And moreover, it is 1:5 RR. If this stock works, I will be getting 10,000 rupees profit for my 1 lakh investment. All these points are tempting me to take a trade. So if you are exactly in this situation, what is the decision you will take? Do you trade or do you leave? Because the risk is higher than what is your maximum acceptable risk. The zone is giving 2% risk, but you cannot afford more than 1%. Or you just forget the risk because anyway all the conditions are in our favor and you want to take a trade because we are going to get 10,000 rupees profit. Definitely, some of us will be tempted, right? We will be thinking anyway the zone risk won't occur. If it occurs, then we will get 2,000. We are having 100% confidence the zone won't be failed. It is going to be successful, no doubt in that. Why should we lose 10,000 rupees profit? If you think like that, you may take a trade. That possibility is there. You just ignored this risk management concept. You just ignored it. You are just believing on your intuition. And if you take a trade, you took a trade, let us assume. You took a trade. The moment you took the trade, all of a sudden market dynamics are changed. The overall market is reversed, and because overall market is reversed, all the stocks also changing their direction. Something is happening. Maybe institutions might have cancelled their order flows inside the zones. You never know that. If they cancel their order flows, we never know. Because chart will be showing the zone is excellent, but they might have cancelled their order flows. Because market dynamics are all of a sudden changed. Then what happens to your stock? It is stopped out. You thought everything is perfect, you won't get loss at all, even though the risk is not supporting you, but still you took a trade. Now how much loss you will be getting? 2,000 rupees loss you will be getting. But how much you can really bear? Only 1,000 rupees you can bear the risk. Just because you ignored these rules and took a trade, you got 2,000 rupees loss. Because you know such kind of things will happen. That's why what you decided, you just ignored this stock. You know all conditions are in our favor. Everything is good. But just now whatever the explanation I have given you, you are thinking about that. Maybe all of a sudden market changes its direction, fail, I will get loss. Then I will get more loss than what I am expecting to get the loss. So with that point, you didn't take the trade. You just ignored the stock. Now what happened? Because all conditions are favor to that particular zone, everything. Market is also normal. It didn't change any dynamically. It supported your stock and now your stock started moving up, but you didn't take the trade. And finally it reached the target and gave 10,000 rupees profit, but you missed the entire profit. How do you feel? You did a very good analysis. And you are 100% confident it will work. Just because the risk is not in your favor, you ignored it. But the stock worked completely in your favor. Whatever you analyzed, accordingly it worked and reached the target and gave 10,000 rupees profit, but you didn't take the trade. That means you didn't get the profit. You missed 10,000 rupees profit after doing a very good analysis for your stock just because of the risk. Even this also can happen, right? So either way is going to be a painful thing. Whether you take the trade or you doesn't take the trade, in either case if market goes against you, You didn't take the trade, but market went against you. That means it moved up. You took a trade, but market is against you. That means stop loss is hit. After taking your trade, or if you don't take the trade but market is in your favor, in either conditions, it is a painful task for us. I mean, a painful incident for us. Then how to handle the situation? Now you can, after listening both these examples, you can ask a question. Is there a way we can take the trade, but the risk should be within 1% level? Suppose if there is a way we can take a trade, but risk is only 1% level. Of course, you can change your condition, your entry levels, risk will be reduced. But whatever I am telling you in this example, they are the final. You cannot adjust anything. Your entry is fixed. Your stop loss is fixed. Your target is fixed. You can't do any more further adjustment. They are the final. That means you cannot adjust any risk. But even then, is there a way to minimize the risk without making any changes to your zones? Yes, there is a way with the help of this position size, but you have to use a different formula, not the previous formula. Whatever the formula you have seen previously, that formula is only if the risk is within your favor, if the zone risk is within your maximum acceptable level. Now you have another formula. If the zone risk is not within your maximum acceptable risk, still you can take the trade. So what is that formula? That is also simple formula. See the condition. This is the second condition. Previous condition is if it is within. Now this is beyond the maximum acceptable risk. If the zone risk is beyond the maximum acceptable risk, that means zone risk is above your acceptable risk. That is what the meaning. So what is the formula? Simple formula. But concentrate. It is a very simple formula. Position size equals to maximum acceptable risk percent. I just gave short name. Maximum acceptable risk percent of a single trade capital. What is our maximum acceptable risk percent? Maybe it is 2% of your 1 lakh capital. Or maybe if it is only 1%, you want to take maximum acceptable. So it is 1% of your single trade capital. If some other person say, I may accept only 0.8%, then the formula says 0.8% of that 1 lakh capital. Maybe it could be 2 lakhs or 3 lakhs. Whatever the capital you are investing, that capital. In our example point of view, I am saying 1 lakh capital. Don't fix that 1 lakh is a fixed value. Whatever the capital you are investing, your capital can be 1 lakh, or your capital can be only 20,000 rupees, or your capital can be maybe 1 crore rupees. So that is your capital, whatever the capital you are investing. And when it comes to the maroon color, whatever I have highlighted, that is nothing but how much you are accepting the maximum. Is it 1% or is it 2%? But it should not be more than 2%. That rule is very clear. We should not trade more than 2% by taking the risk. Your risk should be either 2% or below 2%. Your maximum acceptable risk. Maybe my maximum acceptable risk could be 2%. Maybe your maximum acceptable risk could be 1%. So that's why this value can be changed depending on our rules. Okay. Maximum acceptable risk percentage of single trade capital divided by risk per share. In the previous example, what is the risk per share we calculated? Entry minus stop loss. That is 200 rupees minus 194 rupees. Sorry, 196 rupees. So finally we got 4 rupees per share. That value you will enter here. Is it clear? This is the way you calculate the position size. Say for example, position size equals to 2% of single trade capital divided by risk per share. In the previous example, 2% if you add, you don't use this formula because it is within the limit. So first formula you have to use. But what is the second condition I told? Instead of 2%, now I want to change my maximum percent to 1%. See here now 1%. Now position size, the second formula will work now. Position size equals to 1% of single trade capital divided by risk percent. These are all just examples. I am telling you for this word, what is the meaning of this maximum acceptable risk percent. Now for 1%, this condition met. If the zone risk, what is our zone risk? 2%, is beyond maximum acceptable risk. What is that we are accepting? 1%. So using this formula you need to calculate. How you calculate? What is 1% of your single trade capital? 1000 rupees. Divided by risk per shares. What is the value we calculated? 200 minus 196, that is 4. 4 is the risk per share. That means if the analysis goes, you will be losing 4 rupees for each share. Now let us apply those values here. 1% of 1 lakh rupees divided by 200. 200 is our entry price and 196 is our stop loss as per our previous example. That means 1000 divided by 4, that equals to 250. So what does it mean? This position size formula is telling you, if you still want to trade, even though the zone is beyond your maximum acceptable risk, still you can take the trade. But the condition is you have to buy only 250 shares. You should not buy more than 250 shares. So that is what this formula is telling. Still you can take a trade. Okay, suppose if I get a loss, my analysis went wrong. What happens? Because you took 250 shares, and what is your risk per share? 4 rupees. Here 4 rupees is the risk per share. So how much loss you will be getting? 250 into 4, that is 1000 rupees. See, 250 into 4. You got only 1000 rupees loss. What is your maximum acceptable risk? 1000 rupees. So you got 1000 rupees loss. Suppose a trade is in your favor. Then what will happen? You will be getting 5 times more to this risk. 5 times more to the risk because your RR is 1:5. So what is your reward now? 4 into 5, 20 rupees. So 250 into 20 rupees. You will be getting 5000 rupees profit. If you would have taken 500 stocks, you would have got 10,000 profit. But you have taken only 250 stocks. Why you took only 250 stocks? Because if the analysis goes wrong, you can't get 2000 rupees loss. You have to get only 1000 rupees loss. If your analysis goes right, you don't want to miss the trade because you did a very good study and you identified that stock after doing so much of research, observing the stock, doing all the calculations, your supply demand zone calculations. Finally identified all conditions are in your favor. Odd enhancer score is in your favor. Trend is in your favor. Price direction is in your favor. Location is in your favor. Even it is having EMA confluence, everything. Price hour extension is completed. Now prices entered into your zone. It is having higher success rate. That is the way you felt. But still there is a chance that the zone might be the zone might be failed. It will fail if market goes against you. Overall market goes. If all of a sudden dynamics changes, that will happen. So either case, you should not be disturbed. But what is the trade-off here? We reduced the number of stocks in such a way the risk will be, you will be getting only 1% of the risk on your overall capital. Your overall capital is 1 lakh. But you brought only 250 stocks. And if it is successful, still you are getting profit. Each stock you are getting 5 rupees profit. 5 times profit, not 5 rupees. Sorry for my mistake. It is 5 times profit you are getting. Because 4 rupees is the risk, 5 times to the risk you are getting. That is 20 rupees profit you are getting. Because you position sizing reduced the number. Instead of getting 10,000 rupees profit, you are getting 5,000. Anyway, it's good. We got 5 times return we got, whatever the value invested. Is it clear? Very interesting formula. Very simple. This formula is telling you reduce buying number of stocks. That's it. The main key of this concept is reduce buying the number of stocks. How much level we need to reduce? That is what this formula is telling you. Once you reduce this much number and this number into your risk, that is only your maximum loss. That is 1,000 rupees loss in this example. Suppose if you would have said 0.5% is your maximum acceptable risk, maybe this 250 might have been further reduced. Maybe 125. Instead of 250, you would have brought only 125 stocks. Because your risk is at the least level, you cannot afford more than that. Maybe your number is reduced to 125. See, 125 into 4. See, you are getting only 500 rupees loss. If analysis goes wrong. If analysis is in your favor, 125 into 20 rupees is your profit. You will be getting 2,500 rupees profit. But this profit is only for 125 shares. You are getting 1:5 RR you are getting. Hope it is clear for everybody how with the help of position size, how we can reduce our losses by setting your maximum acceptable risk. But you should remember, you have to use this formula only when your zone risk is beyond the maximum acceptable risk. If it is more than the maximum acceptable risk, then only you have to use this formula. Suppose your zone risk is within your acceptable level, you should not use this formula. You have to use the first formula. But here, people will make one serious mistake. And because of the mistake, again they lose more money. But you people should be aware of that. I don't know how many of you really noticed the point I am going to tell you. Listen, here in this example, what is our position size? 250. So 250. And what is our entry price? 200. 200 is entry, right? Here, 200 minus 196. Entry is 200, 196 is stop loss. So 250 into 200. This is the money you are investing for buying. So how much you invested? 50,000 rupees instead of 1 lakh. What is the remaining amount is available? 50,000 rupees, another 50,000 rupees is available. You know what some people will do? That 50,000 is leftover money. what they do, they will invest that 50,000 rupees in some other stock. That is very dangerous. That should not be done. The reason is, if you are moving that 50,000 to some other stock, now it is as good as you are taking 2% risk and buying these stocks. Your capital for this particular stock is going to be only 50,000. 50,000, 2% loss you will get if it goes. Because if another 50,000 is invested in some other stock. Assume that stock is also failed. Now what will happen? Now your risk is going more than 2%. Here what you have to do, until the completion of this trade, this 50,000 remaining amount, you have to keep it ideal. You have to use this 50,000 only after completion of the trade only. Until completion of your trade, this 50,000 rupees should be an ideal amount. This 50,000 is part of this trade, even though you did not invest. That is the way you have to do the risk management. Here the key is a part of your money keeping ideal and managing your risk. If you don't keep the 50,000 as an ideal, there is no meaning for this concept. But many beginners will do this mistake. Okay, they think that, okay, we did position size, we got 250 stocks, very good. Now my loss is going to be, in case if analysis goes, my loss is going to be only 1,000. Still I have another 50,000 capital is there. Let me invest in some other stock. This is the way people will be thinking. But you should not forget the loss we calculated 1,000 on entire 1 lakh rupees capital. Even though you did not invest entire 1 lakh for buying this. Until the completion of the trade, the remaining 50,000 rupees, you have to keep it ideal. This money should be released only after your trade completes. After that only you have to release this 50,000 for your next trade. This is a very, very important point. I have seen many beginners, they lose their capital because they are not following this rule. They are not aware. First of all, they are not aware. They have to block this money until the completion of the first trade. Until the completion of this trade. This 50,000, remaining 50,000 is part of this trade even though you did not invest. This is part of the entire risk management system, this 50,000, the additional 50,000 rupees. This is the way you are supposed to plan your trades. If you ignore these simple principles, because see, they're all mathematical concepts, very minute level concepts. If you don't have proper observations, see how it is changing your risk management all of a sudden. Hope I made it clear. Now let me show you one real example. You will get even better clarity. And look into this stock. This is the recent demand and supply zones for BHEL. Let me put these values in bigger letters. BHEL daily demand zone, we are planning a trade. And this is the entry price, and this is the stop loss, and this is the target. Target means this is the supply zone value, distal value. That is your target. Entry means this is the distal line of the demand zone. Proximal line. Sorry for my mistake, I am saying distal line instead of proximal. And the target is the proximal line of the supply zone, and entry is the proximal line of the demand zone. And stop loss is your distal line of the demand zone. For time being, for our this training lesson point of view, I did not include stop buffers. Please note this point. Because this is not the real trade. Just I want to explain the stop buffer concept I don't want to increase the complexity of our calculations. So what is the risk per share? Risk per share is your entry minus stop loss. This is the entry value, stop loss value. We got 9 rupees 75 paisa is a risk. That means if the analysis goes wrong and if you take a trade, you will be losing 9 rupees 75 paisa on each share. If it is 100 shares, so 9.75 into 100. So that's why we have said this is the risk per share. And what is reward? Reward is your target minus entry. This is the target value and this is the entry value, and you are getting 36.30 paisa, 36 rupees 30 paisa profit you are getting. And what is your RR? Reward by risk. That is 36.3 divided by 9.75. You are getting an RR 3.7, 1:3.7. So this is a more than 1:3 trade. The minimum acceptable RR is 1:3. For highly experienced, 1:2.5 they will take. Okay, 1:3, it is more than 1:3. It's a good trade. And moreover, this zone is looking good. But what is the zone risk? Zone risk is 100 into this risk per share divided by entry price. What is entry price? 185.65. We got 5.25. That means zone risk is 5.25%. What is my accepted risk level? Maximum 2%. I have selected 2%. Let us assume. But this is more than my accepted level. More than double, moreover. More than double. 5.25% risk. Many people, let us assume this demand zone is extraordinary by all the conditions point of view. Let us assume. Because I didn't completely study this zone. But this is a high liquidity zone. Having a good odd enhancer score. But I didn't fine tune the zone. That is most important. But anyway, let us assume, time being assumed, this is a good zone. At any cost, you want to take a trade in this zone. You don't want to miss this trade. But risk is very high. What many people will do who are not aware of this position size, they just leave this stock. They leave this stock. But it is a good stock. We can buy this in this stock, even though risk is 5%, still we can do position size. Which formula we have to use? Second formula. What is second formula? If your maximum acceptable risk is not within zone risk, because zone risk is beyond the maximum acceptable risk. That's why we have to use second formula. So according to the second formula, first we should know how much money you are investing. So for my BHEL trade, I am using a capital 1 lakh. And the second point, before applying second formula, the second point you should define what should be your maximum acceptable risk. Here I said 2%. Maybe you may set 1.5, some others may set 1%. So based on these two parameters, if you get clarity, then only you can apply the second formula. Okay, your capital is you got the clarity, your maximum acceptable risk you got the clarity. Now what is the formula says? 2% of this 2% of this 1 lakh, that is going to be 2000 rupees divided by risk per share. Risk per share, that is your entry minus stop loss. What is risk per share? 9.75. That means 2000 divided by 9.75. Position size equals to 2000 divided by 9.75. You will be getting 205 stocks. But you will be getting 205 point something. Let me show you. 2000 divided by 9.75. You are getting 205.12. This fraction value you have to discard. You can't buy this. So you have to buy exactly 205 only. So 205 stocks you can buy. Okay, if you buy 205, if your analysis goes wrong, what will happen? 205 into risk per share. This is the loss you will get. So how much loss we will get? What is the value we set? 2000 is maximum acceptable loss. So 205 into each share, how much loss you are getting? That is risk per share. That is 9.75. You will get close to 2000. See, 998.75. That means close to 2000. Because of the fraction value we omitted, that's why you got a very close value to 2000. So that means we are within the risk. Whatever the risk you said 2000, that money only you are losing if the analysis goes wrong. Suppose if the analysis goes right, what will happen? How much profit do I get? Because what is the reward here? The reward is 3.7. So 205 into, risk. What is our risk here? 9.75. 9.75 into RR 3.7. That is your each share your reward into 3.7. So 36 rupees. That is the reward. That is 36.3 here. Because the fraction value missed. This is the reward. 36.3 is your reward. Exact. So you will be getting 205 into 36.3. So you will be getting 7,441 rupees profit you will get. Even though the risk is high, still you are able to manage profit. You are able to get this much profit if your analysis goes in your favor. If your analysis goes against you, you will be getting 2,000 loss. If your analysis is in your favor, you are getting 7,441 rupees profit you are getting. So divided by 2000, that is our risk. 3.72% reward, RR. Actually it is 3.72, but round value I have given 3.7. But here another important point you have to observe. How much money you are investing? So 205 into, what is our entry price? 185.65. So 38,000. So, okay, let me round value for our easy understanding. You are investing only 38,000 rupees out of 1 lakh. That means 62,000 rupees you didn't invest. It doesn't mean that 62,000 rupees you have to use in some other stock. You should not use. If you use, all these calculations will change. Your risk will increase. Until completion of BHEL trade, the remaining value, that is 62,000 rupees, you have to keep it ideal. You should not use that money for any trade. If you want to use that money for other trades, first you have to close this BHEL trade. After closing only you have to use that money. This is the most important point I want to tell you guys. Because many people make this mistake. I have seen several people, they did this mistake. Because after buying these stocks, their account money will be left over. They will be thinking, okay, very good, we have money, let me buy another stock. And ignoring the fact. What is that fact? The moment they invest, these calculations will change. Now all of a sudden the risk for this particular stock is 5.25%. If you invest the remaining money, the 62,000 rupees in some other stock, the meaning is you risked 5.25% for this trade. You are thinking that you risked only 2%, but actually you are You risked 5.25% for this particular stock because you invested the remaining money 62,000 in some other stock. So that is the reason why this is a very, very important point. How much money you are planned for the trade, that money you should not touch, even though you did not buy those many stocks. The reason behind not buying those many stocks is because of your risk management point of view. You want to limit your risk to only 2,000 rupees, the entire 1 lakh capital. The 2,000 risk is not on 38,000 rupees capital. Please remember, your risk 2,000 rupees is not on the capital 38,000 rupees. Your risk 2,000 is on the capital 1 lakh. That is the point you should not forget. So that is the reason why the remaining capital you should not touch until this trade completes. And those people who understand this point properly, then always you will be in safe side when you are trading with the help of the supply demand zone price action. Always you protect your capital. This is one of the techniques in building your capital. This is a risk management concept. There are several ways you might build your capital. So this is one of the techniques, position size. Otherwise, how your capital will grow? Hope you got clarity about this position size. Now let us look into risk management related some important rules. The point we already discussed, never risk beyond 2% on your trade capital. And second point, very important point we discussed, you should not forget. Never use the remaining single trade capital. After position sizing, whatever the remaining capital you got, never use that capital until the trade completes. Because I know people are making mistakes, that's why clearly I specified this point. And also never open all our trades in one sector. Suppose you have 10 lakhs rupees capital. You want to invest 2 lakhs in one stock, 2 lakhs in another stock. Like that you want to invest in 5 different stocks. Don't invest all the 5 stocks related to one sector. Never do that. In each sector you keep only one stock. So diversify them. If you feel a sector is extraordinary, it is performing, maybe you can take 2 different stocks and invest in that sector, not more than that. You have to diversify. We never know when a market dynamics will change. Maybe until you invest in that particular stock, market might be looking very good. Maybe that could be a turning point. The moment invested, market is changing its direction on that particular sector. Because it is very difficult to identify turning points. Until the turning points happen, you never know. The market is changed its direction. So that is the reason why we should be very careful. And next, never open all our trades in one direction. What is one direction? That is either in up direction or down direction. Never trade. Keep some more trades towards the up direction, keep some more trades towards the down direction. But give importance to overall market. If overall market is in a particular direction, in that direction buy more stocks. Against that you buy less number of stocks. So more trades that support the direction of the overall market. Maybe overall market could be your Nifty. If you want to say in favor of the Nifty, if Nifty is moving up, then more stocks you trade towards the Nifty's direction. I'm just giving an example. So always remember, more trades that support in the direction of the overall market. And a few trades or less trades that support in the opposite direction of the overall market. But remember, opposite direction means randomly you should not select the stocks. Whichever the stock, suppose let us assume your overall market is in up direction. Whatever more trades you are taking, all the trades should support up direction. And whatever the trades you are going, that means up direction means long trades you will be taking. In all these long trades, the trend should be up direction. Few trades you are taking short trades. In that short trades, those stocks should support downtrend, because you will be trading in favor of a trend in that particular stock only. If overall market is also in our favor, more success will be there. That's why more stocks. Now you may ask a question: why not all the stocks in the overall direction of the market? Why few stocks we are trading against the overall market direction? This is the question you may ask. The reason is simple. The moment you invested, the overall market might have been changed. Maybe that is the ending point, turning point. You never know until it turns, right? You invested, now market is turned. Now what happens? Whatever the trades you planned in the up direction, they also will change their direction. You get losses. And all these losses is recovered in these stocks. The few trades, when overall market is down, now whichever is currently moving in the down direction, they get even more power, even more fall will be there in the stock. All your losses in this, they will be recovered here. That is what in the beginning I shown you an example. Even after we got 4 losses, one stock saved all our losses. Exactly the same will happen here also. This is the way your capital will be saved. It will be protected. And never initiate any new trades before any major announcements. This is another important. And there is a major announcement is there. Say for example, tomorrow there is a results will be announced in this particular stock. Don't go and initiate a trade in that. You never know how the market movement all of a sudden. So these are all some major events. I'm not telling you every market news we need to react. No. Major things that really influence the market. Only those things. Results is one area might influence. Or RBI interest rates might influence the overall market. Or country's GDP numbers announcement. Or country's manufacturing related numbers. There are some important events will be there, standard events. So you have to collect the data, and accordingly, those days you should be very careful. Maybe globally also some events will affect our market. For example, US Fed interest rates, that will impact all the countries, including our country also. If their interest rates are changed, that will affect our market. So because of these reasons, some important events whenever are there, you should be a little careful. Now a new event is coming, elections. Within another 1.5 months, we will be having. Maybe in next month itself in some states, the elections will start. Until May month ending, elections will be continued. During that time, different newses will come. Different rumors people will spread. And that gives a huge volatility conditions in the market. When volatility conditions are very changed, what happens? Your stop losses will hit. That's why we should be very careful in some such kind of situations when you are planning your trades. In remaining days, you have to proceed as per your normal supply, demand zone, price action concepts. Not only demand and supply zones, these events will impact any technical analysis related concepts. You may ask, there are already order flows are there. How it will impact? You may ask a question. Because of these events, institutions might cancel their order flows. For you, it looks like by looking into the chart, the zone looks very good. But you never know when institutions cancel their orders. These events, these important events, those chances are high. That is the reason why we don't want to take any additional risk there. Because remaining days, everything goes in a smooth way. And use a trailing stop loss effectively to build your capital. Build your capital means, you see, if your profits are improving or increasing, your capital also will improve. Trailing stop loss is one effective method that will help you in getting more profits. The moment you get more profits, your overall capital also will improve. And we will discuss this trailing stop loss in detail in our next video. So if you have any questions regarding this particular topic, and please put your questions in the comment section. I will try to address. Hope this information is very useful to you, because I know it is a very important concept. I am rating this topic is the top most important video among all our training videos. This is not a complicated video, but this is the video, whatever the concepts you learn, that will put you into discipline. If you want to become a successful trader, you should be a disciplined. How we should be disciplined? This concept is clearly explained about protecting your capital. Hope this is useful to you. Let us all meet again in our next video. Thank you.